Not a lot of people know this, that one of the easiest ways for passive income that's reoccurring is dividend stocks and ETFs. My name is Spencer and I talk all about investing with a focus on income. And today I'm going to be breaking down the 4 types of dividend investing. Now, I've been investing for over a decade now with a focus on dividends for the last couple of years. And I'm really excited to showcase all the different styles of dividend investing today. So I hope you guys do enjoy. If you are interested in dividends, in passive income, in making money, don't forget to like the video and to subscribe so you don't miss out on the future content. Let's roll that intro. To truly understand dividends and the 4 types, we have to talk about what a dividend is, first and foremost. So a dividend is a portion of a company's profits that are paid to shareholders. There's a couple different types, and I'm using Napkin Finance, a really good breakdown. You have stocks or shares of the company, or cash. And most people prefer cash. Now, you can do the same thing with stocks. You can sell them and use them as cash. But simply, people typically will invest in a dividend stock for the cash payouts that are paid out to you in your brokerage automatically. Now, there's different kinds of dividends. You have quarterly, you have monthly, you have weekly now. We even have some that pay twice a week, and you have special dividends. And those are a one-time only payment. Now, special dividends can be consistent. There are some stocks that I love that pay special dividends all the time, but they're not required to continue that. And that's why it is considered special. So the reasoning behind this, why are they paying out dividends? Well, it's basically a bonus. And there's a current argument going on that's been going on for quite a long time on growth versus dividends and the pros and cons of each. And well, with dividends, one of the cons is you're taking money from the company that you've invested in that they could utilize to grow further, to advertise more, to build more buildings if it's a REIT, for any number of reasons, to utilize that cash, and they're paying it to you right away. Now, it all depends on your personal beliefs and if you would rather have that money in the hands of the company that you've invested in or in your own hands where you can reinvest it where you like. And that is the whole key of dividend investing. So it's absolutely amazing, specifically for those that are trying to live off their investments that want current income. And that is one of the main reasons people do like dividend investing. For me personally, I like dividend investing because I like to reinvest those dividends. I don't live off my dividends. I will one day, but I don't currently. So I reinvest my dividends pretty simply. Not every time to the company that distributed the dividends or paid them out to me, but I keep it in cash and reinvest when I'd like to. And I will touch more on how I invest with my dividends specifically and which of these 4 dividend categories I use later on in the video, but let's jump into that first style of dividend. Our first category, dividend investing style number 1, is dividend growth. And this is exactly what you would expect. It is the growing of the dividend over time. And there are pros and cons to each of these strategies, but we're going to look at Schwab, ticker SCHD, the Schwab US Dividend Equity ETF that holds 100 companies that are ranked based on the sustainability and quality of their dividends. Some other popular ones are DGRO, DIVO, and even VIG by Vanguard. But SCHD is, I believe, the most popular. And there's a lot of pros to this style. So you're going to get slow dividend growth, which takes patience, but over a long period of time, and I'm not talking a couple months, I'm talking decades, you can compound your dividends and make a very solid return. And with that, you also have a very low expense ratio of 0.06%, which is very cheap in the dividend investing game. And these are ETFs, so you're relatively diversified, and SCHD has proven to be a very quality ETF. But let's talk about the cons. For one, it's slow. It's very, very slow. You have to continue to contribute money. You can reinvest the dividends, which I think most people do, but these are not really strong growth companies. They are focusing on getting that dividend bigger and bigger. And so I'm going to showcase exactly what I mean with the cons of this strategy. We're going to look at some of the most popular dividend growth ETFs compared to the NASDAQ and the S&P 500 over the last 12 months. I've plugged in all of our dividend growth ETFs. We have SCHD, VIG, DIVO, and DGRO. And our last 2 are SPYI and QQQ. And when I scroll down, I have them all on this chart. This is not including the dividends, and dividends are a very important factor. But just based on the growth of the price value alone, QQQ is up 20% in the last 12 months. SPYI is up 13%. And the rest are up anywhere from, SCHD is the worst performer, down 6% in this time. The others range from up 5 to 7.5%. When we go to our total return, we see a different picture. It gets a lot closer, but QQQ and SPYI are still on top by far. And this is where growth versus dividends is kind of a big argument, because to really get a very amazing return on any of these dividend growth investments, you have to hold them for a long time. And the hard part with that is when we have a year like 2025, where even though we've had our dips at the beginning, we've seen QQQ more than double the return of most of these other ETFs. I mean, including SCHD, it significantly outperformed it even with the dividends included. And that's why people argue, why would you even invest in something like this? But again, there are some pros. It is cheap. It is very, very consistent. And if you have enough money, and I am talking millions, not hundreds of thousands, you can really live off of these relatively consistently. And it's pretty simple to do. You just have to have the money up front, which for a lot of newer investors, which is the goal audience for this video that are new to investing in dividends, well, you probably don't have millions of dollars to invest. So is there a better option to make more money right away? Let's take a look. Our second dividend strategy, we're going up a little bit in risk, but this is high yield investing. And there's a number of different vessels you can use to do this. You can use stocks and ETFs. So we're looking at the NEOS website, a very popular ETF issuer, and I'm going to walk through a couple of their ETFs, and then we'll throw all of it into our comparison chart again and see how it stacks up. But the goal with these is to get you 10, 12, even 16% in yield every single year. And that's really it. The yield is the goal. The total return is important, but they typically don't go up in price like you would see maybe with SCHD. It all depends on the underlying and each individual ETF or stock that you choose, but ultimately they're trying to get you around a 12% distribution or dividend, and that's it. That's the ultimate goal. So when it comes to QQQI, these are a little bit newer. A lot of them are monthly payers. The dividend stock side, some of them are quarterly payers, but you have a 14.3% distribution rate and an expense ratio of 0.68, which is a lot higher than our 0.06 from our dividend growth investing category. And these can be a little bit riskier. They're not nearly as risky as our fourth strategy, but I'll get to that. That is by far the riskiest strategy. But depending on if you're using ETFs that are based on options, which most of them are in this category, or stocks that simply target that 12 to 14% range, which I'll list a few of those as well. Ares Capital, you're going to have a lot of business development companies or BDCs in this category, and they kind of tag along with these ETFs. Now, the nice thing is the ETFs are a little bit more expensive than the BDCs, but sometimes the BDCs can be a little bit more volatile, like we've seen these last couple of weeks. But all in all, the goal of these, again, is just that income. So you can live off of it. If you can have enough invested, you can live off the yield, and the price isn't supposed to fluctuate all that much. Now, will the price go up a little bit? Yes, it will go up slightly, but it's capped. And the way that it's capped with these ETFs is the options that they're running cap your upside. So that is one of the downsides to this versus, again, just normal growth investing. But with growth investing, you're not going to get a dividend. So what a lot of people will do, this is a tangent, but with growth investing, they'll just sell a little bit every time they need money to live off of. And while that is a viable option, it is also really hard to sell. Say you have a really bad week, a really bad month in the stock market, you have to sell a bit more of your shares to get that money to live off of. And that's why eventually I hope to pay all my bills with dividends. But we have ETFs on here. We have QQQI, we have SPYI, we have TSPY, we have TDAQ, a lot of great options. We have ARCC, which is an Ares Capital, and I'm going to throw all these into a chart and let's see how they hold up against the typical indices of SPY, QQQ, and see which one comes out on top. Our 6 ETFs for this comparison, we have our test subject, which is SPY and QQQ. We're seeing if we can get anywhere close with our income. Then we have ARCC and OBDC. Again, these are BDC's business development companies. They kind of act as banks for smaller companies that want to expand. They loan out capital. Now, the reason they're a little bit riskier than our dividend growth category is because they can be impacted heavily by interest rates and things of that sort, including what's going on currently, which is why a lot of BDCs are down. Then we have QQQI and TSPY, a NEOS fund and a TAP Alpha fund, two very consistent, high-yielding ETFs. So when I scroll down, I'm going to show you guys, this is just growth. So with growth, we see OBDC is down heavily more recently. ARCC is also beaten up, but then we have SPY and QQQ still on top, but no dividends included. TSPY and QQQI are both, well, they're doing okay. TSPY is down 2.5%. QQQI is still up 4%. When we go to total return, we see a giant shift. So now we have SPY still up to 14, almost 15%, but TSPY is up 12.3%, which is very solid. We have QQQ up 20, almost 21%. QQQI is up 19.5%, a little more than a percent below, and you're getting those dividends right away. And then we have OBDC and ARCC. Now, if we had gone before this crazy dip, ARCC was one of the best performers and has pulled back. OBDC was still up 10%, outperforming SPY, but now has sold off as well because interest rates and things with the economy are a little bit sketchy right now. And that's what's really risky with a lot of these. Now, I am debating buying into a lot of these BDCs. We'll see if I actually do it, but this is our kind of second category of dividend investing. They're supposed to be just consistent 12 to 14% payers. That is the goal. And although we've seen the BDCs pull back, they were doing just that prior. ARCC is one that I own, and it has paid me 13 to 14% a year over and over and over again, with the price remaining pretty consistent, which is why I hold it, because I love to see that growth. QQQI and TSPY are both growing in popularity. We've seen Tap Alpha take off, and these do exactly what they're supposed to do, but they utilize options. And so their expenses are a little bit more than the BDCs. And all in all, they are competing pretty close with growth. We saw QQQI even outperform SPY. That's our first one to beat the growth ETFs with our dividends included. Now, it didn't beat QQQ, but let's jump into our third category of dividend investing. Category number 3 is super unique and really rare, but it is actually my personal favorite. But I have to say really quickly, if you guys are interested in dividend investing and don't have a way to track your dividends, I recommend checking out my dividend tracker below. Let me know what you think. It's the easiest way to track your passive income and make sure your money is working for you. Now, back into category 3. It's dividend and growth investing. No, not dividend growth investing like our first category. This is different. These are typically REITs, real estate investment trusts. You also can have some more BDCs or business development companies, like we talked about in the last category, but these are companies that are focused on growing their share price value while also paying out some very solid dividends. And now what you sacrifice with this, some pros and some cons, typically the dividend yields are a little bit lower because you have some growth aspects. So like ARCC was paying out 12%. Main Street Capital, who I'm showing on screen right now, they pay out about 8%. But with reinvesting and compounding over time, you can make some serious passive income. And what I mean by this is if you had invested in Mains from 2007 to current, you would be up 1,629%. Which is absolutely amazing. You would have bought in at $14.90 a share, and it's currently sitting at $56.57. You would have made $46 per share in dividends alone. Per share is absolutely amazing. And that growth speaks for itself. If you don't reinvest your dividends, it's significantly worse. Your 10K is only worth $69,000 compared to the $172,000. And that's why I like Main as a stock. It's definitely been consistent for me, and it pays a lot of special dividends as well. But there are other options like REITs. The most popular REIT on the market is ticker O. It's Realty Income, and they are known as the monthly dividend company. And what you're getting with that lower yield of 4 to 5% is more money held by the company that's going to allow them to expand. And when it comes to REITs, when they expand, what that means is buying more properties. If you don't know, real estate investment trusts, they make their money by either owning, it can be single family homes, it can be malls, it can be amusement parks, it can be apartment complexes, it can be vacation resorts. But whatever it is, they own the properties and lease them out to people who then pay them to use the properties, whether they be businesses, families, whoever, and they make money on that investment. Now, the cool thing with REITs is if they pay less in yield, they're able to use the actual capital to buy more properties and make more money and expand and grow their share price value alongside their dividend. And that is a key factor with how these are different from the last category that is primarily focused on that higher yield. And again, these are probably the same risk as the prior category, where they are a little bit riskier, but not too bad. They're probably in the same, nothing like our next dividend category. But all in all, I like this style of investing a lot. And I want to show you guys how it's worked over the last year for a lot of popular dividend and growth stocks. So we have our categories again. We have SPY and QQQ. We have Main Street Capital, a growth BDC, and then we have our REITs. So we have ALPS, which is an active REIT ETF, and we have JP Morgan Realty Income ETF. So Realty Income is very, very popular, the overall ticker, but I want to include these ETFs in here because they are an accumulation of a lot of different ETFs, including VICI, NNN, very popular ones. So price return, again, we are seeing a lot of these not do great. We see the REITs are down because they do pay a dividend, which is an important factor, but they've also had a bad year with interest rates. Main Street Capital is beating SPY, but underperforming QQQ, but that doesn't include the dividend. And this is why I absolutely love Main Street Capital. Now, it has pulled back. It was up 40% on the year, but has pulled back with interest rates, with overall fear of recession, and now it is still in first place. So Main Street Capital with 23%, we have QQQ with 21, SPY with almost 15, and then our REIT ETFs have just been underperforming, which is, again, unfortunate, but Main Street Capital is a powerhouse, and it is my largest holding. So not financial advice, but it has done really well for me, and we can see it has performed better than a lot of, the main ETFs, the main indices, QQQ, SPY. So it's very interesting that people seem to sleep on this dividend investment strategy. So let's talk pros and cons. Cons, well, in a bad market, the REITs fall. It really does depend a lot on interest rates and what's going to happen with the economy. In a good economy, they do well. And overall, with the REITs specifically, if you think that property values are going to go down, it's tough. And REITs have been soaring because since the post-pandemic era, property values have gone up exponentially, which is wild. But now BDCs seem to be doing a little bit better, albeit this last drop. So it's very interesting how these two correlate. But pros, when you pick a winner like Main Street Capital over a decade, if it can perform the way it has, you have a massive winner that is going to outperform any growth strategy. It's nearly outperformed growth without even the dividends. When you throw in the dividends, it becomes the front runner in this group. But we have one more dividend class to talk about, the highest risk, one of the newest, and slowly becoming, I shouldn't even say slowly, quickly becoming one of the most popular. But listen, it's high risk, high reward. We're talking high income ETF investing. YieldMax ETFs were kind of the start of this insanely high yielding ETF game. And the way they do this is they all use options, and you're super capped on your upside, which is definitely a con. And so that's why this is our fourth category. Again, it's really high risk. You can make some insane money with it. And so if you're looking to make a lot of money and actively trade, a lot of people utilize this strategy, but a lot of people get burned really bad, especially if the market takes a dip. This whole strategy relies really heavily on the underlying stocks and the overall momentum of the market. So let's talk about it. A lot of these dividends are about a rate of 90% plus. Some of the weeklies are, 30, 40, 50% in the dividend yield or distribution rate because they are ETFs, but the price can be terrible. So what you need is the underlying to perform well. And one thing that's important about this strategy is the underlying is always going to outperform the actual ETF that's writing options on it. It's just the way income works. It's what you sacrifice when it comes to wanting your cash. Now, so I'm looking at YieldMax because, again, they have so many picks now. Now they're all paying weekly. We can see the distribution rates right here, 130 on BABO. 31 on ABNY. Scrolling down, we have some in the 20s, which is very low, some in the 70s, some in the hundreds, MARO at 100. But when you're looking at this, one massive mistake investors make is they see Tesla at 108% and think, oh, if I hold this for 1 year, I will double my money. And that is not the case, because you have to worry about something called NAV. And that's what I'm going to show you guys when I compare a lot of these stocks to, SPY, to QQQ, because it is very high risk. So I'm going to take some winners and some big losers and talk about exactly how I play these. I don't put a lot of money in. It's all fun money because, again, these are high risk and this is not financial advice, but I throw these in to kind of track and see which ones are performing really, really well and how some people have made a lot of money with this strategy. But again, it is extremely risky. So we have our standard SPY and QQQ. We have ULTY, which is one of the most popular, rapidly growing ETFs by YieldMax, a weekly pair. These are all weekly pairs now. We have TSLY. We have MSTY and CONY. These are a lot of the most popular income ETFs. Now, looking at the chart on the 1 year, SPY and QQQ have not changed, 13% and 20%. ULTY is down 49, almost 50%. Tesla is down 25, almost 26%. MSTY is down 55%, and Coney is down 52%. And this is called NAV erosion. And what happens is they're paying out such high dividends, such high distribution rates, that you're getting a lot of income, but your overall investment is going down in value. They're paying you your own money in a sense. But what you do with that is up to you. You can reinvest it. You can put it into a different asset. You can put it into a different ETF, different stock. But let's look with the dividends, how they have performed. So if we go to total return, we can see the story changes vastly. Now SPY and QQQ are looking the same. They also have a little bit of a dividend, which is why we see a shift for those two. ULTY is now winning. It's up 25.8%. It now has outperformed SPY and QQQ. TSPY is winning big, up 66%, because Tesla has been doing extremely well. MSTY or MSTY was at one point up 90%. It was outperforming SPY and QQQ by 75% plus, and then it fell. CONY took a dive recently, but was doing really well during this time as well, up 54, 58%, and has now fallen off. So what happened? Why did they fall off? Well, their underlyings took a dive. The way these options work with these ETFs, you need the underlying to continue going up, to continue to have high implied volatility, to pay out really big premiums or really big dividends. And what that does is, when it's good, it's absolutely amazing. But the minute the underlying starts to fall, these have zero protection and they fall like crazy, as we saw with Coney and MSTY. So what's key here is we recently saw Tesla run. So it went up quite nicely by like 20%. And so Tesla did really well. It started paying out a lot in dividends, and the growth of the fund, you could actually see it kind of bounce back in price value. Now, when we zoom out even more, it can get a little bit hairy. We've seen some of them do really well, but all in all, they do not perform well. I mean, we see Tesla, we see ULTY down here. It's a little bit rougher, but the 1 year is just a prettier chart, and it's easier to understand. So with this strategy, pros and cons. Pros, you can make a really good return. You can do it quickly. You can have huge dividends if you're trying to live off dividends or retire early. This is one way you can do it faster if you do it perfectly, which is nearly impossible. The cons, it's expensive. All of these have very high expense ratios. You can lose money very quickly in a down market. We have not truly seen a bad down market. In the beginning of the year of 2025, we did see a bit of a dip, and look how all of them fell significantly. I mean, MSTY was the best performer, and it went from being positive 45% to being positive 7%. So in a down market, they get hit hard. The actual QQQ and SPY ETFs do not get hit nearly as hard. And so that is one major factor. So what people will try and do, and I kind of mentioned this, they'll swing trade these. If Tesla's going up, they buy Tesla. If MSTY's going up, they buy MSTY. And or if MSTR is going up, they buy MSTY, which is also correlated to Bitcoin. So there's a lot of factors that weigh in on this one. It's the highest risk strategy. These are a lot of new ETFs. We haven't even seen them for like 2 years yet. So they're very, very new, and they're very, very risky. And again, they are very, very expensive. The expense ratios range. I mean, ULTY is 1.3%. Remember, our dividend growth strategy was 0.06%. It is wild how expensive these ETFs are, but the reasoning is they're complicated to run and they can do really well depending on the underlying. So out of all 4 of these, which one do I utilize the most? Let's talk about it. Right off the bat, you'll notice I do hold a little bit of each of them. I do hold SPY and QQQM, which is a version of QQQ, kind of the same thing. I hold a lot of Main Street Capital. I hold a lot of ARCC. I recently bought TDAQ, which is the NASDAQ version of TSPY, and I hold QQQI and SPYI. I also have ULTY. I also have a couple of our leveraged weekly pairs, but I like to utilize a number of different strategies. So I have some in growth, which is consistent and makes me money over time as the stock market goes up. I have some in income focus, like ARCC, that's going to build itself a portfolio. It's going to continue to reinvest those dividends. And when ARCC goes down, I simply buy more. I have Main Street Capital that I try to buy on dips, but it rarely seems to dip. So every time it does, I scoop up more, but I'm not reinvesting my dividends anymore. What I do now is I buy whenever I see a drop that is good enough for me to go, you know what? It's time, let's buy in. And it's made me quite a bit of money, I will say. Same thing goes for TSPY and QQQI. They don't dip nearly as much as some of these other rockier assets depending on the market, but if we do see QQQ or SPY fall, I do buy more of those as well. Typically, I'll set the income ETFs to just reinvest dividends, and it's a lot easier, but I also like to track everything by hand using that dividend tracker I mentioned earlier. So if you guys are experimenting with dividends, I really recommend leaving a comment. Let me know which of these 4 types are you using for your dividend income. 1, is it dividend growth with SCHD, VIG, DIVO? 2, is it that consistent ETF and BDC income where there's not a lot of growth but consistent high yields? Is it 3, growth plus dividends, where you're getting that growth of the underlying asset and some dividend income to bolster your compounding? Or is it 4, kind of swing trading these high yielding, high risk assets? I'm curious to see where everybody is. I make content on all of these. So if you are interested, don't forget to like and subscribe. We can grow our dividends, we can grow our portfolios together. And I do hope you found this video useful and enjoyable, I should say. I hope you did have fun, because it was really fun to make. So again, if you're interested, don't forget, like and subscribe. If you like this video, you're gonna like these popping up on your screen right now. And again, the most important thing is don't forget to spread some love today.